What are the most notable trends in the restaurant industry right now? Hello, this is Jonathan Mays, editor-in-chief of Restaurant Business. And in this week's episode of A Deeper Dive, I speak with Joe Pawlak, the managing principal for Restaurant Business sister company Technomic. And we talk about the Technomic Top 500 Chain Restaurant Report, which is out right now. The Top 500 is essentially data on the chain restaurant industry, since that data makes up the vast majority of chain sales. We talk about some chains on that top 500, including the chicken business, in which we chat about Popeyes and KFC and which one of those chains has been able to thrive in a changing market for chicken restaurants. We also talk about how top heavy the top 500 is getting, given performance of chains at the top. We also talk about which sectors are doing the best and get into a discussion on the beverage business, which is fascinating. We also talk about which chains have the most potential to hit the top 10. We're talking top 500 on A Deeper Dive, so please check it out. All right, I'm here with Joe Pawlak. Joe, welcome again to the podcast.
Thanks, Jonathan. I appreciate being on.
All right, so we're talking once again about the top 500. And the first question I'm going to ask is about the chicken market, because I find that fascinating. Do you remember, you've been around for a little bit, you remember, go back, say, 10 years, 15 years. Would you have ever thought that Popeyes would overtake KFC in the United States?
No, never. I never.
How unusual is that?
You know, if you go back to 1970, do you know that KFC had more units in the U.S. than McDonald's?
They were big, yeah. They were the biggest restaurant chain in the country for a long time.
Yeah, so they certainly have somewhere missed the boat. You know, we've got all these other chicken chains, Popeyes, certainly Chick-fil-A, and you know, a number of other ones have surpassed them, and will probably surpass them. Others will surpass them soon.
I mean, yeah. If you, I didn't necessarily mean to start. I mean, it's you know, I mean, KFC was a monster for a long time, and it really hasn't been a monster for 25 years. I mean, it's been, and that's going on, you know, a quarter century of basic stagnation, if you will. And then meanwhile, Popeyes was just as garbage. It was a sort of a niche chain that had it was a mostly regional Southeast concept for a long time. You know, it didn't even have its own recipes. So it didn't even own its own recipes. They didn't buy back their recipes from Al Copeland until 2014. 2014. That's like not even a decade ago. And for that chain to overcome KFC, I mean, Chick-fil-A was one thing.
Well, you know, I think the watershed moment was the chicken sandwich that they introduced. I don't know. Again, time flies for me. It was 6-7 years ago when they introduced that sandwich, and it just they went gangbusters after that, and they've been doing everything right since.
Yeah. I mean, they've kind of cracked that code, right? Because nobody else. The weirdest thing about the U.S. restaurant industry is I think the consumer is really not going to trust you on certain things outside of your core, which, you know, in some respects is really good. But I mean, neither they nor KFC nor Church, nobody could really do a chicken sandwich. Remember, they couldn't do one. They tried. I mean, I think the world is littered. I mean, KFC had their zingers, which worked literally everywhere else in the world except the United States. So they couldn't get the zinger to work in the United States. Yeah. So, and then nobody could do a chicken sandwich until Popeyes did. And of course, that put them in a different stratosphere, gave them permission to do all sorts of things, go into different markets and do different things.
Yep. No, absolutely right. And it's, you know, it's one of those things that, you know, you have somebody at the top for, again, so long, and they just slowly are eroding market share. And, you know, certainly the consumer has kind of moved away from KFC. And, you know, is it fixable? They've been trying to fix it for quite some time. You know, you look at all the different initiatives. I can't even remember all the initiatives. Wasn't there a chicken gold initiative back in the 90s? They tried to hop on the back then was the home meal replacement bandwagon. You know, we were talking about dinner, and when the supermarkets were jumping on that in the 90s, and they didn't quite hit the mark there. So, you know, what's the next act? I think everybody's asking about.
Yeah. It's a great question about KFC. Like, and I mean, I mean, we thought for a while that because their marketing was really good there for a few years. I mean, they were getting a lot of attention. We also forget that they're probably the ones that put Nashville hot chicken on the U.S. bandwagon. I mean, you could make an argument that Dave's hot chicken today probably doesn't exist to the extent that it does if KFC doesn't release their Nashville hot chicken first, like they did.
Right.
So their marketing was doing real well, and then they just sort of fell back off again. I mean, their first quarter was terrible.
Yeah.
In no uncertain terms. And even I don't know if you listen to earnings calls religiously like I do, but Yum Brands is generally their executives are typically glass half full types, to put it mildly. They really are. I mean, like most executives are for the most part, but Yum Brands is at the top of that list. But even they were pretty honest about like KFC has serious issues. And that's not their direct quote, but they basically said to that effect, that KFC had issues and it needs fixing, because like they've stagnated for, they had some momentum, they were going, and I don't know if it was a marketing change or what. They had a successful chicken sandwich introduction and they just never, it did real well, and then they just fallen back down to earth. And I don't know if it's because they're not spicy enough like Popeyes is, and maybe that's it, or spice matters, man. It does actually. And maybe they just fell back to earth, but the KFC has some work to do. If they let Popeyes pass them by, that's
well, are they unique enough as well? I mean, are they just following, or are they doing something different? Is always the question too. Followers usually fall off at some point. So
right.
Trial can get you a lot of business short term, but it's not enough to sustain if you're not doing something different.
Yeah. All right. So on the top 500, was there anything that actually stood out to you from this year's list? I mean, it was pretty. Last year, it was sort of, I would have put it benign. That's kind of.
Yeah, I think you're right. What really kind of stood out to me is McDonald's doing 9% and not adding, I think they added 14 units that are 13,500 they had. Again, a lot of that we know is inflation. If when you're looking at market inflation at 7%, but still at 9% for a company that big, that a mature company, if you will, in the U.S., that stands out. Also, the steak chains, when you think of like people like Texas Roadhouse, Longhorn, kind of the ones that are, I would kind of put in the upper casual space, doing relatively well. We think about people cutting back, Fogo up 22%, kind of telling you that there's still money out there, but it's at the higher income levels, right? The lower income, as we're hearing, are getting priced out of the market. But there's money out there, and people at the higher ends, higher middle class and above, are still spending money and going to restaurants and still spending at steak. And when people think about special occasions or when they want to spend money, they're going to spend the money. They may not be going out as frequently, and they actually may be trading up a bit to steak. Why should I go to a mid-scale, typical traditional casual dining? I may not go there as much, but I may skip 2 occasions and make it 1 occasion to a steak restaurant. And I think that's what's happening. We saw some of the fine dining did relatively well last year, which was kind of interesting to me. That's another, I think, aha. And then just beverage. You look at Dutch Brothers, Seven Brew, Scooters. How much room is in that market? Everybody has a beverage on their menu in the QSR space, as especially coffee. Everybody's playing around with it, but these new players are coming out and doing Dutch Brothers up 20+%. Seven Brew, which is the fastest growing chain above $200 million, 250% plus last year. Scooters up 41%. So. Again, it seems there's still a lot of headspace there to grow. Now, again, and then Starbucks had a bad first quarter. it appears that Starbucks is the problem, not the category. So we're seeing some, a lot of growth still in that beverage space.
Yeah. Starbucks is definitely the problem.
Yeah.
It's not the category.
Yeah.
I mean,
Well,
I've said we could talk 30 minutes about Starbucks in their I guess their fiscal second quarter alone.
Yeah.
Because they, if we talk about something going on with the chain, there's something, and I think they're facing a massive backlash right now, and it's to an extent really out of their control. But like the beverage sector, I mean, you're right. 7 Brew, 267.3% sales growth. And then you got, you got Dutch Bros, which has done really well. You've got a bunch of, scooters. I mean, 40.9%. And then, Dutch Bros, their first quarter, their corresponding quarter to Starbucks, their same store sales were up 10%.
Right.
And I've been making this argument on Twitter. I'm like, if you've been to Dutch Bros, you know that they're not any cheaper than Starbucks. All of these companies price roughly the same. I mean, Dunkin' is a little bit cheaper on balance, but in some markets they're not. So, it's not a price issue, with Starbucks. So, but there is a lot of demand for beverages, which is fascinating, because like regular restaurants are losing their beverage sales. Just generally speaking, like beverage attach in the restaurant space has been on a downward slope.
Right.
Which is why Subway switched its beverage contract to Pepsi, because they want more beverage attached. Their beverage sales have been stagnating and they have issues. But people are flocking to drive-through beverage concepts, and they're getting all sorts of stuff. And in fact, the interesting thing to me here on the beverage side of it is that if you think about how broad-based the beverage business now in the United States is, think about the things that you can get, right? You can get bubble tea. I can't stand this stuff, but apparently the kids do.
Kids love it.
Yeah, the kids love it. And God bless them. You know what? They do their thing. That's great. I am going to stick to my generic diet soda and hot coffee, and I'll be fine mostly. But like you've got cold coffee, you've got dirty soda like Swig,
right?
Which is a fascinating concept in itself. You got all of these different beverage concepts are just like flourishing right now. That's why McDonald's wants to do Cosmics, because that's a great. I mean, right now, beverages is a great business.
Yeah, no, it is. It's great margin. At the end of the day, look at the input costs. They're not very high. Look at what they're doing with carbonated soft drinks with Swig. Input costs aren't very high for that, and look at what they're charging. So it is a good business. And you talk about Starbucks woes. You can read the social media and you see, yeah, there's not a lot of positive comments about Starbucks today. And and you're right. There's a lot of things outside of their control they can't really deal with.
Yeah. That sort of gets, like one of my theories right now, Joe, is that the U.S. restaurant business is demassifying, what I mean by that is the consumer is going to go to you for X and not Y. So they view, McDonald's is the exception, so kind of put them aside. They're going to go to Raising Cane's because they want chicken fingers. They're going to go to Chick-fil-A because they want a chicken sandwich. They're going to go to a beverage, if they want to get something to drink, they're going to go to whatever these chains are, 7 Brew or Starbucks or Dutch Bros, whatever. And they're going to get the specific beverage that they want. They're not going, you can't really be an all things for all people type concept anymore. You have to focus and specialize and do really, really well at what you do. And you can't, the idea of the veto vote should be buried. Actually, it should be printed out on a piece of paper, burned with the ashes buried several feet deep into the ground, and then just ignored for the rest of their lives, because that doesn't exist. People are going to you for what you specialize in. And if you're enough operator here, that's what I would focus on. I would focus on my core menu offering,
Yeah,
and that's what we
it's
see all.
in this environment where menu prices are, I mean, based on government data, are 25, 20, 30% higher, probably higher when you start adding fees to it. Nobody really is calculating fees and now tipping and limited service, and you feel like a schmuck if you don't do it, right? So, let's call it 32%, 35% higher than they were in 2020. You want to get exactly what you want, and you want the best in that category, right? So you're spending a lot of money, so you want to get the expert to do it. You don't want to go to a broad menu restaurant to get chicken fingers. If you want chicken fingers, you want to go to a restaurant that specializes in it and does it right. It has something unique. So you go to what? You go to Raising Cane's. Or if you want wings, you know what? Wingstop does it really good, so I'm going to Wingstop. Or if you want a burger, you know what? I'm going to go to Five. So those are the guys that, if you specialize, you're in a catbird seat today. If not, you're in trouble. And that's why I think what we call varied menu, casual dining has been struggling. And it's been struggling for a number of years, but now we're really seeing them struggling. And that's a problem.
No. Let's since we're talking about casual dining, you mentioned steak. Let's talk about Texas Roadhouse for a minute. What the hell are they doing? 13.8% growth according to the top 500. Now They are within shouting distance. Probably, I mean, Olive Garden generally does okay.
Right.
So it'll be a few years, but eventually Texas Roadhouse is going to be the largest casual dining restaurant chain in the United States, and I don't think there's any question about that. What are they doing right?
It's a destination for middle America to get a great steak. Now, and it offers value. Middle America understands that, I got to pay more, but you know what? If I have to eliminate 3 occasions for a casual dining restaurant, a varied menu casual dining restaurant to go to Texas Roadhouse, we're going to do that because we perceive it as, again, value. And I say value, I mean quality's there, service is there, atmosphere is there, and by the way, I get a great meal, and I'm willing to pay more for it. And I think that's what's happening, and they continue to do it. Right? They just do it time and time again. So at the end of the day, that's what's bringing the customers in. Again, it's for middle America. It is a great experience, and it's someplace that they're willing to, again, save up, if you will, to go to eat.
Mm-hmm.
It's accessible. It's accessible too. They have a number of units. I don't have to dress up to go in there, but I'm still getting this great meal. Right? They don't feel intimidated going in there as well. It's very comfortable.
Yeah. It's a nice place. I mean, I've never gone to Texas Roadhouse and said that was a terrible idea.
Yeah.
Actually, I could say the same thing for Applebee's, and they did not have the year that Texas Roadhouse is. So, I mean, it's you get really good service. The steak is pretty decent. Those rolls and that cinnamon honey butter is to die for. The service is always phenomenal. I mean, they just do things the right way.
And I think this whole waiting time too kind of begets waiting time. It's kind of like they got a lot of traffic. This must be good, right? I think that kind of builds on itself, and waiting times haven't gone down in Texas Roadhouse from what I can see.
Right. No. Now, Applebee's and Chili's, probably in a year or two, Chili's overtakes Applebee's, which is actually really interesting.
Yeah.
Because those two are, if you want, to me, an idea of how a brand should operate in these days, I think you probably could do, really well to just examine what those two chains are, because they're basically they're I mean, frankly, and no offense to anybody, any of these chains, but they're basically the same thing for the most part. I mean, they have, they emerged around the same time. They had the same heyday. They had roughly the same model. I mean, we used to talk about the sea of sameness with casual dining and bar and grill chains all the time because they would have kitchen on the walls or whatever. And I mean, what the heck is Chili's doing that Applebee's isn't? Why are they doing? Because they 6.3%, and again, that's not that's not in Texas Roadhouse territory. But when you look at Applebee's down 0.1%, and then you look at what's going on with TGI Fridays, and then you look at the shell that Ruby Tuesday is, I mean, Chili's is actually doing something right down there.
Yeah. Well, one thing and again, I think this contributes to it. I don't think it's the total answer is how they've positioned themselves against fast food, even, 10.99, burger side, bottomless side, and bottomless beverage. You know what? I can't get that at my local McDonald's for that price. Right. And that has a certain clientele that says, you know what? I'll spend a little bit more time to get that. And I think they've done pretty well with that. And they've kind of expanded that to other menu items. So I think there's some, especially in these times where inflation is going through the roof, not only in the restaurant industry, but in every, we're seeing inflation popping up in other areas of the economy where people are just cash strapped in general, or seeing more money going to other necessities. They're looking for, well, where can I get a deal? 10.99 for, just about everything that's a great deal. So kudos to them. I think they've kind of found this formula within casual dining. Now, how sustainable is that, especially if commodity prices in one of the commodities, we know beef is certainly very high right now, but they've probably, bought in, on the futures market, et cetera. But, that could come into play at a certain point. But, I think that's one of the formulas, is that they've kind of found this value, and they're competing with fast food, and it looks like they're doing pretty well.
Yeah. Yeah, no, they're doing very well. You know what? I'm beginning to think that Kevin Hochman, the CEO of Brinker, is a pretty decent executive. Because, I mean, when we started, we talked about KFC. And the last time, when KFC's era, in which it was building sales growth, it was building sales and doing all this marketing, its marketing was working. It was doing all this good stuff. And Kevin Hochman was in charge of the U.S. chain at the time. And so he was in charge of the chain the last time they had unit growth in the United States, that they didn't go negative, and then they've gone negative since then. And then he goes over to Chili's and has essentially got us talking, because there's a lot of talk about, to your point, about Chili's and their value friendly menu online right now, but they're doing it in a way that you don't actually have to, I mean, it's a good value, but they've been engineered that value menu to target those consumers.
Yeah.
Yeah. And here we are now having this conversation about whether Chili's is cheaper than McDonald's. It kind of is, and it isn't. I mean, it's so they've done real well for themselves. So speaking of McDonald's, and you mentioned that 9% sales growth, last year, and the one thing I think that's been marked in recent years with the top 500 is how increasingly top heavy the industry is getting. And look at this was the top 4 chains in their sales growth, 9%,
right.
12.5% for Starbucks. Again, Starbucks problems are very sudden.
Right.
But last year they did 12.5% sales growth, and that's with a somewhat substandard end of 2023. And then 13.4% for Chick-fil-A, and then 8.2% for Taco Bell. And it drops off a little bit until you get down to Chipotle. But I mean, it helps probably if you're a really big chain, I think, these days. Yeah.
Yeah. I mean, again, when you have muscle, you have marketing dollars. You have innovation pipeline. You can be innovative. You got technology. You have access to technology. You have investment dollars for technology. So you have all those benefits working for you that you're able to, again, help that to drive sales at the end of the day. So yes, that's what we're seeing. And again, they continue to take share. If you kind of stratify the top 500, if you look at, 1 to 10, 11 to 100, 100, 101 to 200, 201 to 300, they're the fastest growing. As you said, at 9%, everything's below that. So again, that's you kind of look at, you got the investment dollars, you can do a lot of things.
Mm-hmm. Yeah. Yeah. It's just, it's difficult, I think, to break through in a market like this. And the more marketing muscle you have, the better. But it has to be effective.
Yeah.
So at the end of the day, I mean, we've seen countless stories of ineffective marketing and stuff like that. And currently, market is actually quite challenging, to say the least.
Yeah.
One last point. About a weekish or so ago, I wrote a piece essentially determining that these three chains are really the next. I mean, if the next Chipotle, for what you will, and they're all roughly the same size. Raising Cane's. Sales growth 20.5% last year. Jersey Mike's 25% sales growth. And then Wingstop, for God's sakes, 27% sales growth. And they're going to do that again this year, by the way. I mean,
yeah, you see their same store sales this first quarter.
I mean, my God. I mean, I don't like, it's another restaurant chain that has broadened its, we've had them on their podcast recently, but they've really broadened their customer base all of a sudden, and they're going to be unstoppable. I think they're going to be tough to beat. But those are the three chains. I mean, like if you look, those have the strong of the chains in the top, 40, 50, chains with an established history are generating the strongest growth right now. Any one of those chains could one day at some point be a top 10 chain. I don't think there's any question about it. Would you agree with that?
Yeah, I mean, they're certainly on that trajectory. What can hold them back? Change of ownership at some point, right?
Mm-hmm.
We're hearing rumors about Jersey Mike's, obviously. What does, going to the private equity market, how does that change the culture, change the, the philosophy of how to grow? That could be an issue. But given what we're seeing right now, I can't disagree with that. Those are, you're looking at the categories. You look at, chicken wings and chicken strips, handheld chicken, certainly overall is a fast growing market. Better for you sandwiches with Jersey Mike's, where there's experience behind that, where they're cutting the meat in front of you and preparing it in front of you. That's what consumers want, so they see it's fresh and it's authentic. Kind of the mantra that Subway lost, that they had this fresh positioning, and look who's kind of overtaken that is Jersey Mike's, because they're actually slicing it in front of you as an example, and doing all those other things. And they also have a hot grill there so they can make hot sandwiches for you on top of that. So I completely agree with you that they can be they rise into the top 10 or, top 15 very shortly.
Yeah, super. Joe, this was great. Always love talking to you about the top 500.
I do too. And go Bulls.
Sure. And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.